name's Jeff Marshall. I run the fixed income team and lead the private markets effort at CI Global Asset Management out of Toronto. The private markets offering is new in Canada. It's new to Australia. Sophisticated investors have been using private markets as a building block as part of their portfolios for a long time, and we thought, it was time to build a better access vehicle for investors, either in the Canadian market or the Australian market. And it was, how do you come to this with experience and scale and resources, get the portfolio construction right, and get the manager selection right, because that can be a very significant driver of performance over the long run. So the investment process is really centered on a portfolio optimization that tried to solve for, obviously, returns and volatility and liquidity. And that actually had us going in the direction of a fund of funds program that invested in private equity, in private credit, in infrastructure, real estate, and venture capital. And then handing the manager search over to our very large 30-person team in the US. So they're running a quantitative screening to try and find the right managers. Then they get involved with qualitative due diligence, and then an independent kind of third-party analysis that we use for Mercer to try and winnow down our portfolio needs. What complements existing exposures? What exposures do we want given our outlook with the existing portfolio? I think if we were looking to build a portfolio optimized just for returns, we'd probably be leaning a lot into private equity and into venture capital. So this is absent any tactical asset allocation where we're taking a short-term view. If we were trying to optimize that portfolio for liquidity, we'd likely be in private credit. Most private credit managers are making one-year loans and then refinancing them, or they're getting refinanced into the public bond market. And if we were optimizing just to mitigate and minimize volatility, we'd probably be heavily focused on infrastructure. So putting these 4 or 5 building blocks together with some public market securities as a bit of a liquidity buffer in the funds, we think that's the better mousetrap for investors. So we're looking for diversification by asset class, as I mentioned, also by manager strategy, and also diversification by vintage. So all else being the same, as I think about liquidity and evergreen structure, a 2018 vintage fund is going to return capital sooner than a 2025 vintage fund. So there's that's element. And then we also invest in some closed-end funds and some evergreen strategies to give us kind of an extra layer of diversification and liquidity. And then within our asset classes, we're trying to keep the number of managers relevant so we can stay on top of what they're doing. We want to be important to them so we can drive synergies and pricing breaks. And so when I'm looking at a manager, I'm quite happy to be in their fund 5. And if nothing's changed and they're continuing to deliver and we're still want to be overweight or exposed to that part of the market, we'll get involved in their fund 6 and their fund 7. So I like having offsetting strategies. And so I like direct lending, and I like having distressed credit next to it as a bit of a portfolio diversification within private credit. So we looked at sophisticated pension sovereign wealth investors who had upwards of 30, some cases 50% of their portfolio in private market investments. And generally, they do not have a liquidity requirement to their liabilities. So they can get paid to take illiquidity risk. Now, I think that depends really on each individual client. What are their liquidity needs? But for the most part, clients do not need to have daily liquidity on 100% of their assets. And so you can get paid for that illiquidity risk. So we approached it from that tenet. And then we said, well, what if we look at a 60-40 portfolio or a 40-40-20 portfolio? What do private markets do to optimize their portfolios? We looked at 5% weights. We looked at 10% weights. And generally, the addition of private market portfolios into otherwise public market portfolios reduces volatility and is incrementally positive for return. So it improves portfolio efficiency. And really that's, this efficient frontier 101. It's just adding a poorly correlated asset into our portfolio is going to improve the Sharpe ratio. So that was the approach that we took. We're incredibly privileged to have a very deep team across CI, our US business, Corient, and GSFM. But um, my background is in public markets. You make an investment and you're in the market, and just the waiting. You make a commitment to a manager, and they're a disciplined manager. They have a process, and they might be putting 25% of their capital to work in any given year. And so, kind of having that capital set aside, because we don't intend to use leverage, but having that capital set aside um, in T bills or in cash, kind of waiting to be deployed. That was more of an issue early when we first launched the funds, and it's less an issue as more capital comes into the funds and we get more of that vintage diversification. So joining me on the fund is my co-manager and our chief investment officer, Marc-Andre Lewis, and he was previously head of portfolio construction at the Abu Dhabi Investment Authority, where he uh, found the way to optimize what was otherwise a public markets portfolio with private market fund investments. Marc-Andre has a very quantitative background. He has a PhD in physics. He understands financial modeling and math at a much higher level than I do. So, in terms of driving that strategic asset allocation and doing the Monte Carlo simulations, trying to optimize what's the right asset mix, a lot of that was driven by Marc-Andre. We have an assist with another quantitative analyst, and then just based on anecdotal conversations with managers, what we're reading, what we can infer from the public markets, that might drive some tactical asset allocation shifts in the portfolio. So kind of out of the gate in 2023, we wanted to be underweight real estate because we saw that public market valuations had reset very quickly to the repricing of interest rates, where private markets had not. There was a wide bid-ask spread. As we're looking at distributions and subscriptions and flows in the funds, we're looking at our strategic asset allocation, our tactical tilts, looking at fundraising. So which funds that we own are currently still open for investment? Where might we need new managers or funds? Who's actually open? And so that might drive us giving a manager search to a due diligence team that numbers about 10, and they're largely based in the US, although there's one individual based here in Toronto. And then there's a sourcing team of about 20 additional people that are more tangentially involved in the private markets across CI's US business. And they may have an existing relationship. So if we want to add European infrastructure, there may be an existing relationship that we can lever, or that the due diligence team already thinks very, very highly of. So in broad strokes, that's the what is probably about a 40-person team tackling this. We wanted to do infrastructure. We wanted a second manager. Our existing exposure was more U.S. centric, so we wanted a European infrastructure manager. A lot of the activity in the infrastructure space is in Europe, and that was one of the tasks that we gave our due diligence team. So they go to the Mercer database, whether it's 10,000 or 11,000 different funds, and you start winnowing that down. Well, who's open? Who meets that criteria of European centric? Let's filter. You begin to filter by drawdowns and correlations and returns, the consistency of returns. We can talk about DPIs, IRRs, and you start winnowing that quantitative analysis, so the number becomes a much more manageable subset. And then you can look at the Mercer due diligence reports. The way we like to put it is, if Mercer likes you, we might do business. But if Mercer is giving you a failing grade or a poor grade, that's going to exclude you from our search. We can even look at things on a qualitative basis. So the definition of what is infrastructure can be broad. It can include data centers. Some infrastructure managers like to include social housing or hospitals, and we did not want that in our investable universe. And so that allowed us to winnow the subset down even further. And it gets to a manageable level of about 10 to 12 managers or funds, where the qualitative work really begins, where it's meetings with the managers, reference checks, background checks, operational due diligence checks, before the due diligence team comes back to Marc-Andre and I with a recommendation of 2 or 3 funds, and then we discuss what might be the better fit um, for the CI private market funds. And then we can begin commercial negotiations in terms of what kind of price breaks uh, we can strike. It's our thinking that the strategic asset allocation of our funds is not going to change. The tactical asset allocation might change 5 to 10% here or there. We're always going to hold 10% in public market securities. That's our liquidity buffer. And we're getting, in our growth vehicle, we're going to hold about 35, 40% in private equity, 10% in venture capital, 10% in real estate, 10% in infrastructure, and I think that leaves about 30% in private credit. Private credit, again, providing that liquidity down the road in terms of making short-term loans. It's fair to think about valuations. It's fair to think about valuations versus the public markets. It's fair to think of valuations infrastructure to PE. Where are credit spreads in the private credit market? Where's credit spreads in the private credit market versus high yield? Everything's interconnected. So again, the SAA won't change, but we will make some tweaks to the tactical asset allocation based on where we're seeing opportunity. I think what's going on in the private equity space is a phenomenal evolution of the space. There's a liquidity problem, a lack of distributions via sale, via IPO, and LPs are not getting the distributions that they're used to, and therefore cannot rebalance as they have been able to in the past. And so we now have a much more liquid secondaries market. We have continuation funds. In my mind, it feels like, well, if it's not a seller's market, liquidity is tight, then it must be a buyer's market. So I like putting new money to work in private equity here, and you'll see that with a slight increase in our tactical asset allocation weight. Access is increasingly important. So as I think about CI's business across Canada, the US, and Australia, we are well north of $500 billion in AUM and AUA. So we're a very relevant counterparty to the private market firms that we want to partner with. And I believe our acquisition by Mubadala will only further strengthen our ability to access, top tier managers. And so what it means that we're coming in and we can talk to allocations or commitments to funds, $50 million, $100 million, or $100 million to start that can grow to north of $200 million when I think about our three geographic regions. One example that I do talk to because it's a matter of public record is we wanted to get involved in real estate. It was part of our strategic asset allocation. It was 2023. We didn't want to go into private market real estate equity because we saw this valuation mismatch. But it was very rewarding. Yields were very high, spreads were high to do real estate lending. And so we had an existing relationship with Apollo across CI and Corient, and they were launching a new strategy that allowed them to do real estate lending or real estate equity. And we looked at Apollo, we could see their real estate track record, we could see their credit track record, and we could infer that they'd be successful in the strategy. And the deal we struck with them was if we could get to $100 million over the course of 12 months, instead of paying 1.5 in 15 or 1.5 in 10, we would pay 1% and no performance fee in perpetuity if we could get to that $100 million, and we did. So that's a very significant cost savings that we can drive compared to your average retail advisor or investor. I think you want to challenge all the managers that you're partnered with on scale, experience through multiple cycles, and resources. So I think we bring that to bear. In terms of the risks that I worry about, liquidity is always kind of first and foremost. There's been some real estate funds here in Canada, some private credit funds that have put their gates up, and that's just something that I very much want to avoid. And I think with public market securities in the portfolio, with evergreen and closed-end structures, with different asset classes, different managers, multiple vintages, I think we've solved for that. I think one of the other risks is just the evolution of the private markets. They are maturing. I worry that as they mature, they're going to become a bit more efficient, past returns or past outperformance over the public markets. might be a function of some of that inefficiency. But I do worry about market evolution and continuation funds, like continuation funds. This next iteration of what does private equity do when you can't sell your underlying investments? Um, you know, you you can spin a great story, but at the end of the day, returns are really only generated when assets are sold. And so I do worry at points in time that um, the market broadly can get too cute in terms of trying to solve for problems that don't exist. I think one of the things that I'm concerned about elephants in the room is the phenomenal growth in private credit. I think it's really easy to say that you're doing private credit, very hard to do, and it's less so the underwriting. I mean, the underwriting process has to be experienced with scale, with resources, but the origination part can be very, very difficult. You just can't turn on your Bloomberg and source supply. You need to be part of a network. Now, what we're seeing some of the banks. So cities partnered with Apollo, Bank of Montreal's partnered with Canal Road Group, one of our partners in the funds. Because banks have realized in this regulatory environment, they're much better brokering below investment grade risk than warehousing on their balance sheet and taking that capital charge. So they're very willingly disintermediating themselves. So that I think explains some of the growth of private credit. But I do think you're going to see quite a wide dispersion of private credit returns between the managers that understand how to price risk and manage risk, and managers that are just trying to put risk on the books because they've raised a lot of money. And so we've been very, very diligent with our manager selection in private credit. That's, in my mind, the biggest elephant in the room. We are packaging what the large pension plans like Canada Pension Plan Investment Board, the sovereign wealth funds, the superannuation funds are doing with, in some cases, tens or hundreds of billions of dollars in terms of multi-manager diversification across multiple strategies. We're packaging this with a like amount of resources in terms of the eyes and the years of experience on portfolio construction, strategic asset allocation, manager selection, and we're packaging in a multi-manager, multi-vintage way, which we think over the long term, probably drives returns that are 1 to 2 to 3% higher than the public markets, and ultimately, in the context of how does this work with a client's 60-40 or 40-40-20 portfolio, I think it optimizes our portfolios by reducing risk and slightly lifting expected returns.